Every day, millions of people lose money in the financial markets. Stocks, crypto, forex, options. They watch their screens turn red. They close their trading apps in frustration. And almost all of them believe the same thing. They believe their money is gone, that it disappeared into the market. But that is not what actually happens. When you lose a trade, your money does not vanish. Not a single dollar disappears. Instead, it is quietly transferred through a hidden financial system most traders never see. A system that moves billions of dollars every day, from the public to a small group of financial institutions. And once you understand how this system works, you will realize that trading is not what you think it is at all. When a trader places a trade, it does not simply enter the market. It enters a private infrastructure operated by their trading platform. Whether it is a stock brokerage, a crypto exchange, or a derivatives platform, the process is the same. Behind every trading app is a real-time risk operation. This operation does not exist to predict price direction. It exists to control financial exposure. Every trade a platform accepts creates potential liability on its own balance sheet. This is the part most traders never see. They believe their platform is a neutral bridge. In reality, the platform becomes part of the trade. From the moment you click buy or sell, your position becomes a risk that must be managed. Not emotionally, mathematically, continuously. This is where your money begins its real journey. Most traders imagine that trading platforms simply forward orders to the market. This is a comforting idea. It suggests the platform is a messenger, not a participant. But in reality, modern platforms operate like financial control centers. Every position they accept changes their own exposure. If too many users are positioned in one direction, the platform itself becomes vulnerable. So platforms do not treat all trades equally. They analyze user behavior constantly. Who tends to lose? Who tends to win? Which patterns are statistically dangerous? Which flows are predictable? This information feeds into internal risk engines that operate continuously. Platforms are not betting on markets. They are managing probability. Their primary business is not trading. It is survival. Inside a trading platform, positions are not simply processed. They are evaluated. Each trade is measured for risk, not just individually, but collectively. If a large number of users build similar positions, internal exposure grows. At this point, the platform must decide what to do with that risk. Some exposure is kept inside the platform's own system. Other exposure is pushed outward into the financial network. This process is called routing. But what is being routed is not the trade itself. It is the risk attached to the trade. Platforms are not matching buyers and sellers. They are redistributing financial liability. This is the hidden machinery behind every brokerage. Inside every major trading platform, whether it is a stock brokerage, a crypto exchange, or a derivatives platform, there is a number that never stops moving. It is not a price. It is not a chart. It is total exposure. At any moment, that number can shift. A single market move can turn a balanced book into a dangerous imbalance. This is why exposure is not monitored trade by trade. It is monitored system-wide. Platforms are not watching individual users. They are watching the shape of their entire book. Because danger does not come from one trader being right. It comes from many traders being right together. Exposure control exists to prevent that scenario, not to increase profit, but to prevent collapse. Most people assume trading platforms are stable institutions. In reality, they operate under constant structural risk. Because when too many clients are positioned the same way, the platform itself becomes trapped on the other side. This is called correlation risk. It is the most dangerous risk in modern trading infrastructure. Thousands of small positions moving together are more dangerous than one large trader. During major market events, this happens frequently. News breaks, prices surge, Public traders rush in the same direction. Positions cluster. Exposure spikes. At this point, the platform is no longer optimizing performance. It is defending its own balance sheet. This is how trading platforms collapse. Not slowly, but suddenly. Trading platforms are not designed to hold extreme market risk. They are designed to redirect it. To do this, platforms maintain direct connections to large institutional counterparties. These connections are not conveniences. They are structural safeguards. When internal exposure reaches predefined limits, risk is pushed outward by design. Positions are hedged. Exposure is transferred. Pressure is reduced on the platform's own balance sheet. During volatile market conditions, trading operations shift into stability-first mode. The objective is no longer efficiency, it is containment. Without this ability to externalize risk into deeper balance sheets, modern trading platforms would not function under extreme market conditions. So when a trading platform pushes risk outward, where does it go? Not to a single institution, into a network, a web of professional counterparties known as liquidity providers. This is the hidden institutional layer beneath retail trading. Risk does not stop here either. It moves upward, into larger and stronger balance sheets. This is the gateway into the upper financial system. This is where public trading losses become institutional flow. They are connected through prime brokers, clearing firms, and interbank systems. Each institution manages its own exposure, just like trading platforms do. And just like platforms, they do not hold unlimited risk. So when a liquidity provider absorbs a large position, it does not simply keep it, it redistributes it. Part of the risk is hedged with another institution. That institution hedges part of it with another. This creates a chain, a domino network of risk transfer moving upward through the financial system. What began as a retail trade becomes institutional flow, and what begins small becomes structurally important. This is how the system prevents overload at any single point. Risk is spread upward across stronger balance sheets. As risk moves upward, it becomes more abstract. Retail trades turn into institutional positions. Institutional positions turn into interbank exposure. At the top of this structure sit the largest financial institutions in the world: prime brokers, major banks, global market-making firms. These entities do not merely trade markets, they stabilize them. They operate with balance sheets large enough to absorb massive flows. This is where risk ultimately settles, not because they want retail exposure, but because they are the only ones capable of carrying it. The financial system is shaped like a pyramid. At the base are millions of retail traders. At the top are a small number of institutions powerful enough to absorb global risk. Why someone must absorb global risk? At the top of the financial system, there is an unavoidable reality. Risk cannot float forever. It must sit somewhere. Every trade ultimately creates exposure that cannot be passed upward indefinitely. At the end of the chain, someone must hold it. This is not optional. It is structural. Modern markets only function because a small number of institutions are large enough to carry global risk on their balance sheets. These institutions act as shock absorbers for the entire system. Without them, markets would seize during every major event. Liquidity would disappear. Prices would gap uncontrollably. So the system concentrates risk at the top by design, not because it is fair, but because it is necessary. These institutions do not absorb risk blindly. They are compensated for it. They operate with advantages unavailable to anyone below them. They see more order flow. They access cheaper capital. They hedge globally across markets and instruments. They earn from spreads, financing, and structural positioning. Risk is not their enemy. It is their business model. Where retail traders face randomness, these institutions face mathematics. They do not need to win every trade. They need to manage the system itself. This is why the largest financial institutions grow larger over time. They are not just participants in markets, they are part of the market's infrastructure. This is where the financial food chain becomes clear. Retail traders supply constant flow. Trading platforms manage and filter it. Liquidity providers redistribute it, and large financial institutions absorb and monetize it. This does not mean every institution wins on every trade. It means the system is structured so that capital flows upward. Fees, spreads, financing costs, execution advantages. Over time, these accumulate. Retail traders experience variance. Institutions experience consistency. This is the structural advantage at the top of the system. Not prediction, not luck, but position. Seen clearly, the structure is simple. Retail traders sit at the bottom. Above them are platforms and brokers. Above them are liquidity providers. Above them are major banks and financial institutions. Each layer is designed to be more stable than the one below it. Risk flows upward. Stability flows downward. This is not a moral judgment. It is system design. For most traders, losses feel personal. They assume something is wrong with them. Their discipline, their intelligence, their strategy. They blame themselves for outcomes that were never fully under their control. Because the structure of the system is invisible, they see only the surface. A losing trade feels like a personal failure. But in reality, they are operating inside a hierarchy designed long before they arrived. A system where professional infrastructure competes against public participation. This creates a dangerous psychological trap. Traders internalize structural disadvantage as personal weakness. They keep changing strategies. They keep chasing perfection, believing that if they were just smarter, the system would finally reward them. But the system does not operate on individual effort. It operates on structure. This misunderstanding is one of the main reasons traders burn out. They are not just losing money, they are losing confidence in themselves. Once you understand how the system is built, trading stops feeling mysterious. Losses no longer appear random. They appear structural. You begin to see markets not as a battlefield of individuals, but as an engineered system. A system that redistributes risk through layers of infrastructure. This does not mean success is impossible. It means success requires understanding the environment you are operating inside. You stop asking only where price will go, and start asking how the system itself is designed to function. This is the difference between reacting to markets and understanding them. When you see the structure, you stop fighting illusions and start dealing with reality. Your money never disappears. It moves through a hidden financial architecture designed to keep global markets functioning. Retail traders see only the surface. Institutions operate inside the machinery. Understanding this does not guarantee profit, but it replaces confusion with clarity. If this breakdown changed how you see the markets, support this investigation by liking the video. And if you want to understand what happens inside the financial system before the headlines appear, subscribe to Market Black Box, because this is only the beginning. This is Market Black Box, exposing how the financial system really works.